Hello. Welcome to another segment of Ask Janae. Today we're going to be discussing everything about retirement plans. There's a lot of information that we're going to be giving you today. So never fear, we're going to go ahead and have the slides available for you after, or please like and subscribe to one of our social media platforms, and you can view it or replay it at another time. So if you happen to miss it, also, you can replay it. All right, so yeah, I'm just going to go ahead and give a few minutes for a few people to jump on here as we start getting ready. I will just go ahead and tell you a little bit. You know what? I have figured out how to. Let's see. All right, so, and I can't really tell. So I'm going to go ahead and bring up the slides here and just kind of tell you a little bit about who we are. Ask Janae. I do these segments every Monday at 11 a.m. I do them on various tax topics that will help you save literally thousands of dollars on your taxes. If you ever wonder why billionaires have to pay zero to little tax, it's because they have staffs of financial and tax planners that help them come up with deductions and save them money. So not all of us have the ability to do that. So we like to, give a little education to taxpayers that can help them save money and give them different ways to reduce their tax liability. All these educational videos are free. Just join us anytime Monday at 11, and there will be another topic. So you can also go to our pages, Altair Business Solutions page on Facebook, Altair Tax Relief on Instagram, or YouTube. They're all replayed. It's Altair Business Solutions on YouTube as well. And if you want to stay in touch, also, you could join our newsletter or check out our website at altairbusinesssolutions.com and see a list of our upcoming live streams and see if there's any topics in there that you might find would benefit you. And if we don't have any on replay and you don't see any on the schedule and there's a topic that you really want to know more about, then go ahead and reach out to us and we'll be happy to prepare live stream for you, and we can talk about those different topics. All right, so a little bit about me. Okay, so today's presentations again is on retirement plans, and we're gonna and a little bit about me. Whoops. On the profile of me. Anyway, I've been doing this a very long time. Most of my experiences in managerial accounting as a CFO or controller of a manufacturing company. I've also done, I was a professional trainer for accounting software for a number of years and also cost analysis for construction industry. So I have a heavy costing accounting background. I completed my degree in accounting and business, and I have passed the enrollment or exams, and I am an enrolled agent and have been preparing taxes for probably the last 20 years. So anyway, that's a little bit about me, a little bit about our company. We basically like to consider ourselves the advanced bookkeeper or accountants that actually cares about how much our clients pay in taxes. And we just don't simply prepare your tax returns. We help you get the best result possible. That's our goal, is to have our clients pay the least amount of taxes possible. Okay, so let's jump into it. The table of contents for today, like I said, there's a lot of information. There's a lot of slides. I printed them out. It was almost like a book. So anyway, Lars did a fantastic job, as usual, putting these together for the show. So if you want access to the slides, Lars, go ahead and put it down in the comment sections. If you have any questions, at the end, we can do a little Q&A and discuss any of those questions that you might have. So hopefully you can stick around to the end. Like I said, it's a lot of information. It's not the most exciting information, but we're trying to make it at least a little bit, more interesting, hopefully, and provide you with good information that will benefit you. Okay, so today we're going to do a lot of surveys. It's going to go over a lot of statistics of who's actually saving for retirement, and then we're going to discuss how to actually set up 3 steps to find out how much you need to save for retirement. We're going to discuss the 9 best retirement plans in August 2024, and what is retirement planning and why is it important, and a little experience. Okay, so we're going to go ahead and talk statistics. I know it's everybody's favorite subject to talk statistics, but it's a lot of good, valuable information. All right, so 56% of Americans feel that they're behind on saving for their retirement. So for many Americans, basically, it's kind of a milestone, right? It's like, it's like saving and buying a house. Is actually the question we might be asking ourselves, will I even have enough money to save a retirement? Will I even be able to retire? And so that's a lot of, that's a big question for a lot of us. If we haven't been saving in our retirement plans, or, we need to catch up because we're older and we were just not really sure if we're going to be able to retire. So nearly 1 in 3, or 32% of U.S. adults working full-time, part-time, or temporarily unemployed, they estimate they would have to save $1 million to retire comfortably. And that's so more than half of the American in the workplace says they believe they're on track and they should be able to make it by, but that doesn't mean retirement is impossible, even if you are behind, because there are ways to catch up on your retirement. And we're going to discuss, like I said, a lot of the different types of retirement plans at the end of this segment. So it'll give you more information if you're self-employed or if you're an individual taxpayer, of what plans would benefit you most. Okay. So the percentage of workers that think they're actually behind on their retirement savings remain relatively unchanged as of 2022. Okay, so 56% of the American workers feel that they should be on track, or where they think they should be on retirement savings, including, go back. 56 of Americans feel they're behind. And 37% of those 56% believe they're significantly behind. And there's a number of percentage that don't even know how much, or how much they actually need to contribute to retirement to retire comfortably. So around 1/4 of the workers haven't made contributions in the last year. 22% of Americans said that they weren't making retirement contributions in 2023 or 2022. And a lot of it has to do with inflation and the ability of spreading our paychecks further. And so often then individuals will think, well, I'm just not going to contribute to my retirement plan. And so, and as I always advise my clients, it's very important to pay yourself first. So if at all possible, please make those contributions to your retirement on a regular basis. Okay, and workers' ideal retirement funds may reach 7 figures. And it's basically going to be where you live, what type of assets you're holding, and whatnot, where you're going to actually be able to maintain your lifestyle, and also, retire comfortably and meet all your obligations. The slim majorities believe it's likely they'll be able to save enough to retire comfortably. 52% of Americans say that it's likely they'll be able to retire comfortably. 45% believe it's unlikely. And again, 3%, they don't know. Okay, so we're going to go ahead and break it down a little bit further. Okay, so as to who's actually contributing and what. So 1 in 3 Americans think they are significantly behind on their retirement savings. Okay. Only 16% of American workers feel that they are ahead. and 21% of the workers feel that they're on track. Now, okay, so the Bankrate Senior Economics, Mark Hammett, said retirement savings goals seem to be slipping through Americans' fingers. However, armed with the correct information, with information and financial resources, they can turn this around and gain a firmer grasp. So we're going to break it down, like I said, of who's actually contributing and which generations contributing, and income and education and all that, how much that affects how they contribute to their retirement plans. So Gen Xers, who are nearing the end of their prime working years but are too young to retire, are the most likely generation, 69%, to say that they're behind in saving for their retirement. 69% of them said they're behind. Okay. Meanwhile, 60% of baby boomers and 49% of millennials and 42% of Gen Zers say the same thing. They are significantly behind on their retirements. So we went ahead and put, Lars has a graph up here so you can see the graph and how much these people believe they're significantly ahead. These people think they're slightly ahead. That little next one. And then this blue line here, they think they're on track. And this one's slightly behind. And then all these guys here are significantly behind. And here's your, I don't know. Okay. So 1 in 4 workers haven't contributed to their retirement in the last year. Only 1 in 4% of workers are saying that they contributed to their retirement savings before August of 2022. While 36% said they are contributing about the same amount as last year. 17% they were contributing less, and 22% weren't contributing last year at all. Okay. Meanwhile, generations most likely to be contributing. Okay. So you want to ask yourself who's actually contributing to their retirement plans. Gen Zers are the most likely generation to say they are saving less compared to last year. 17% said they don't save this year or last year. 29% also 15% of boomers said they are saving less compared to last year, and 26% said they didn't save this year or last. And again, review the charts if you like the charts. All right, so let's break it down by income and by education, because it also seems to be a factor. If a person is making less than $50,000, they basically are less likely to contribute to their retirement. Okay, workers that 50 annually likely to contribute more to the retirement year over year. However, higher income households don't necessarily have a higher chance of contributing, and that's quite interesting. So here you got 17% if you make it under 50, 28% if you're making between 50 and 80,000. 80 and 100,000, 24%, 34% if you're making 100,000 or more. Also, those with the most 4-year degrees are most likely to contribute more to their savings. And that probably is more in line with the income. If people with high school diplomas, there's 20%, some college at 22%, 4-year degree at 28%, and a postgraduate degree most likely to save, and the retirement is 33%. So many workers say they're going to need over $1 million in their retirement savings to feel comfortable and to live comfortable. And especially, like I said, if you're in a high income, state like California and New York, you may need significantly more, depending on what your expenses are, whether or not you paid off your home, your property taxes, and there's so many other factors that go into determining what you will need to maintain your lifestyle in retirement. Okay, so we asked a total, by the time you retire, how much money do you think you personally need to have saved to fund your retirement and live comfortably? So, however, large percent of workers, 25%, don't actually know how much they need to have save in their retirement to live comfortably. Baby boomers who are either close to retirement age or are already old enough to retire, and most likely generation to not know how much they need to save, which I find is very interesting here. Baby boomers, right, are the most likely not to know how much they need to retirement. And I got to say, with all the inflation, the higher interest rates, and it makes it more difficult for us to stretch out our paychecks or our income so that we can make sure that we have. It makes it a little more challenging to decide how much we need to have in retirement. Okay, so here we break it down again by Gen Z at 20%, millennials at 24%, Gen X at 25%, and boomers at the higher percent, right? 29% don't know how much they need to retire. And similarly, based on income, if you make less than 50, and you can basically read the chart here. If you're making less than 50, it's 28%, and then it goes down the higher income, but just slightly. It's really not that much of a difference, and there's not really that much of a difference in education. More than half of the workers say they'll be able to save enough to retire. Though a majority of the workers, 52%, say they're going to have enough for retirement, 45% of workers say it's highly unlikely. That's a lot. That's a lot of Americans that won't be able to retire or don't believe they can retire. Now, I'm going to say this in full disclosure because I'm not a financial planner. And I think it's very important that people have a financial planner. So we're going to talk a little bit more when we talk about what you need to do to set up a retirement plan and determining how much you need to retire. Okay, we asked, thinking of how much money you need to have saved to retire comfortably, how likely, if at all, do you think it is that you'll be able to save that much? I mean, $1 million, that's a lot of money to save, especially when you haven't even, you may not have even started yet, or you're behind in saving. And so retirement savings build over time. And accordingly, the younger generations are a little bit more optimistic that they're going to be able to meet their retirement goals. And let's see, we've got Gen Zers. Let's see. Millennials are the most likely, 62%, to say that they're going to go and believe they'll make enough money. And most likely 34% don't think they're going to have enough in the retirement. Gen Xers are the most likely, 57% of the generation do not feel optimistic that they're saving enough for retirement. That's my generation. Well, Gen X, or I guess technically I'm a boomer, but I identify with Gen X by 3 months. Anyhow, so let's go ahead and talk about 3 steps to find out how much what we need for retirement. You may know you need to save for retirement, but do you know how much you need to save? Is $100,000 enough? Of $1 million? Not everybody knows the same amount, and not everybody's going to require the same amount. So we're going to discuss a few of the how we need to do it. Consider your options. What are your options as a taxpayer to save for retirement? Well, you can have a 401k and IRA plans, traditional IRAs, Roth IRAs. There are a number of different retirements and all have different tax implications. So that's where I come in. We're going to talk a little bit more then about how we could save money on our taxes by using these different types of plans. Okay, now we're going to do the math. And a good way to do the math, there are a number of retirement calculators that are available online. You could go ahead and use your retirement calculator. It basically helps you crunch the numbers of what you will need for your retirement savings. If you need more advice, seek professional help. I always advise this. I work with a number of different financial planners. I like to work in conjunction with financial planners because they are the ones that can provide you these products. They're the ones that are experts on these products and what investments that you need to make. And I like to work with them and determine the best tax uh, deductions, or the best way to reduce your tax liability by using this as a deduction for self-employed, or if you're just a regular individual taxpayer and contributing to your 401k or other types of retirement. Okay, so again, what is retirement planning and why is it as important? Well, retirement planning involves the estimating amount of money that you are going to need to retire. Many people don't even start thinking about retirement until they reach their 40s and 50s, and this could be a major disadvantage of you because it is so much easier to start contributing to a retirement plan earlier in life so that you don't feel you need to be making all this catch-up contributions to your retirement plan, and you can feel more comfortable about planning for your retirement. So here are the key steps in retirement planning. One, we're going to estimate how much money you're going to need to retire. How much do I need to retire? It depends again on how much you're going to spend during retirement. Okay. Do you own your home? Are you going to have to make house payments? Are you going to have medical bills? Do you have insurance to cover those medical expenses? Or are you going to have to pay out of the pocket expenses? Financials often suggest replacing about 80% of your current income during retirement. Now, if you're struggling now at your current income, you may want to bump that number up if possible. But again, this is where we just, we recommend discussing this with a financial planner. And managing healthcare costs during retirement. And this is a huge one because a lot of us don't expect to have medical issues, but obviously as we grow older, our medical expenses do increase, and we might need supplemental insurance to our Medicare plans. And so it's a good idea to talk with an insurance expert to make sure that you are covered in your later years for your health care benefits. Determine how much to save each month within these accounts. Okay, once you've estimated how much you need to retire, you're going to also have to, you'll also want to factor in the expected investment returns, because you're putting money into a retirement plan. But you also, in the retirement plan, most of these plans are investing, and they're investing into the marketplace or investing in different areas to actually help improve your retirement. And again, this is why we work with a financial planner, because they are the experts on determining what are the best investments for you for building wealth and your risk tolerance, depending on your age. So that's very important. Okay, and whether or not you should be contributing to a traditional or a Roth IRA, and when in life might be best for you to be contributing in. And we'll discuss the differences between the traditional Roth IRAs and 401ks here shortly. Okay. Choose your investments. Okay, so these are the number of types of investments that you will most investors will choose from are the stocks. Are you so stocks? Those might be a higher risk tolerance. So because you're actually on the investing in stock in the stock market. But if let's say you're getting closer to retirement age, you'll might shift your portfolio towards more of a fixed income investments, such as bonds. Many investors like to use mutual funds or exchange funds because this is a diversified portfolio that lowers your risk tolerance. Basically, there are a bunch of different funds and different types of funds that work together and to hopefully achieve the ability to not actually lose money, but in conjunction will earn your more money into your retirement account. Periodically review your investment and retirement plans. This is when you call your financial planner and you want to go over make sure that you're currently on track, make sure you're invested in the right investments. And it may also make sense to rebalance your investment portfolio if you want to change your allocations for different risk tolerances within your portfolio. Okay. All right, so here in this section, we're going to go ahead and talk about the different types of retirement plans and what are the pros and cons of each one. And then we'll also discuss more of the tax implications and how it will affect you. Now, employer-sponsored plans. And employer-sponsored plans either are a 401k or a 403b, depending on what type of entity or what type of entity you are. And you can also choose a Roth 401k plan if you want that. But most often, employer-sponsored plans also contribute to that, or they have a matching contribution, which is excellent. I always say, make sure you take your free money. So make sure they at least put in enough in your 401k or your 403b to get that match, because that's significant. That's going to help you significantly down the road. Okay. So you also have your individual plans, and these accounts come with lower contribution limits than the employer-sponsored plans. So you can't really give as much into these plans, but you can have a traditional IRA that allows you to contribute to an IRA while reducing. It basically is a pre-tax contribution that actually lowers your taxable income. And you also have a Roth IRA. And the difference with the Roth IRA is you pay the taxes when you open the Roth, so that when you go to get your distributions later in life, they are non-taxable. A standard traditional IRA, the distributions would be taxable. Okay, you'll have several options when it comes to choosing investments for your retirement portfolio. And again, this is based on your risk tolerance. Stocks can be volatile, although we've seen really big, movement, really good. Our 401ks have gone up a lot over the last couple of years, so that's been really good. But again, once we get into higher, we might want to go for, something that is less volatile, such as bonds. Or mutual funds or EFTs. They're basically similar to a mutual fund. Typically come with lower investment minimums and the trade throughout the day, similar to stocks. But pay attention to a fund's expense ratio before investing, because you want to make sure that you're not paying out too many fees and so forth on these plans. Okay. Now we're going to talk about the 9 best retirement plans in August of 2024. Defined contribution plans. Since their introductions in the 1980s, the defined contribution plan was included, which include 401ks, have really taken over the retirement marketplace. We basically don't get pensions anymore. Companies don't pay pensions. Roughly 86% of Fortune 500s offer defined contribution plans rather than traditional pensions. Okay, so the 401k plan is the most common, because this is for your corporations, in the marketplace. There also is a 403b plan, and these 403bs plans are offered to nonprofits. Okay, so if you're a school or you're a nonprofit, then or if you're a church, you would have a 403b plan. And there is also a 457b, which is used for state and local governments, and that is how they their plan for saver retirement. The employer contributions for limit for each plan is $23,000 in 2024. $30,500 for those 50 and over that need to do makeup contributions. Many of these plans offer a Roth version. So if you want to go ahead and pay the tax, so then when you go to because taxes are relatively low right now, but if you, in the future, we don't know what our tax rates are going to be. So it's sometimes a good idea to contribute to a Roth so that you have your tax-free distributions. All right, so 401k plans. Again, this is your traditional employee plan that most of us are familiar with. The 401k plan allows these contributions to grow tax-free, and they aren't until they're withdrawn at retirement. And when they are withdrawn, they are basically at retirement, distributions create a taxable gain. It's not the same as income, but it creates a taxable gain, and that gain is taxed through the withdrawals. But now, if you have withdrawals that you make before 59 and a half, you would be subject to the tax as well as a 10% penalty on that if you ever needed to go ahead and take money out of your retirement plan. And some certain plans do offer like emergency distributions. Some are more flexible than others. Sometimes you can take a loan against your 401k plan if you need to take emergency money, that therefore you wouldn't be hit with that 10% penalty. Okay. So the pros and cons of the 401k: it's easy to save for retirement because it's already administered by your employer. It basically comes out of your paycheck. And I always recommend, when you get that raise, make sure you bump up your retirement savings. So you really don't even notice, your income's going up, but you don't really notice the additional money's coming out for your retirement plans. Now, the cons of a 401k plan is that you have the penalty for accessing the money if you need it for an emergency. And that we basically just discussed that there are certain ones that will allow for certain emergencies. Now, what does it mean to you? The 401k plan is the best way to save for retirement. And if you can get bonus match money from your employer, you can save more quickly. Yeah, it's always great to take that free money. If your employer is going to give it to you, make sure you at least get the match. Again, 403Bs. This is basically the same thing as a 401k, but it's used for public schools, charities, some churches, some churches that offer actual retirement. They will set up a 403B plan. It's basically exactly the same as the 401k. It allows you to accumulate tax-free until you take out the distributions after retirement. Or if it's before retirement, you're going to get that same 10% penalty. All right, so here's the pros. It's easier to save, basically the same thing. The money can be invested in a number of investments. And so basically the same thing as a 401k. The cons, like the 401k and the 403b, the plan can be difficult to access for if you have emergencies. But again, you might be able to take a loan, or that some financial institutions do offer a little more flexibility for withdrawals for emergency situations. So the 403b is the best way for workers in that sector to save for their retirement, basically for the nonprofits. Okay. Then a 457b is for government or workers or school, employees of state, school, and governments, and some tax-exempt operations that they're actually not a benefit nonprofit. So they would be basically set up as for 457B plans. Now, the 457B can be an effective way to save for retirement because it's tax advantages and allows for catch-up contributions. Same penalty. Okay. The typical 457B plan does not offer employer match. That's where it's different from the 403 and the 401k. Those allow for your matching. Okay. So what this means, the 457B plan can be a good retirement plan, but it does offer some drawbacks compared to the other defined benefit plans or defined contribution plans. And by offering withdrawals from the typical retirement plan, there is the additional penalty. Okay, so IRA plans. IRA plans are for the individual. So if you're an individual and you want to contribute, you might not have an employer-sponsored retirement plan, or you might, but you still have some opportunities to save. Again, talk to your financial planner. An IRA is a valuable retirement tool, allows you to contribute $7,000 to an account in 2024. And if you're over 50, you can contribute $8,000. Now, there are many types of IRAs, okay, and we're going to discuss each one. I know it's a lot, but we're going to tell because they're each taxed differently, and some give you much greater tax benefit depending on your situation. So you have your traditional IRA, your Roth IRA, spousal IRA, a rollover IRA, a SEP IRA, which is self-employed, and a simple IRA. And so we'll go ahead and discuss those here, the different types. Your traditional IRA is a pre-tax. So all the money that you put in reduces your taxable income the year that you make the contribution. It's really helpful. It's very helpful in reducing your tax liability. The IRA allows contributions to grow tax-free until the account holder withdraws them for retirement. They become taxable. Okay, early withdrawals, again, has the same penalties. They really wanted you to save. Okay. Now, so the pros and cons is it's a very popular account. Your investments can be stocks, bonds, CDs, real estate, and other things within your IRA. They are a lot more flexible. If you need to take out, you can take out $10,000 up to $10,000 if you want to purchase a new home. And they're a lot more flexible with you not being penalized to access some of that money. Okay. If you need but the cons are, if you need your money, a traditional IRA can costly to remove it because you actually have to pay the taxes and penalties. But again, like I said, they're a little bit more flexible with allowing you to withdraw money for certain life milestones. Might be for healthcare costs or certain things that emergencies that you would basically not have to pay the penalty. Now, what it means to you, what it means is a traditional IRA is one of the best retirements around, though you can get a 401k with a matching contribution that's somewhat better. So if you've got that in with your employer and you have an option to save your retirement in a 401k or a 401(b), then you're going to fare better because you've got your employer matching and the contributions are much higher, as we are soon going to find out. Okay. A Roth IRA is basically kind of the same thing as a traditional IRA, except for you pay the taxes when you're making the contribution. So when you take the money out, you don't have to pay any taxes. And that is really beneficial because and keep in mind, your contributions, but then also all of your investments are accumulating, right? And those are accumulating. So a Roth IRA is a really good idea, especially, if you could build up that wealth and it's all going to be tax-free at distribution. Pros and cons of Roth IRA offers several advantages, including the special ability to avoid taxes on all money taken out of the account in the retirement at age 59 and a half or later. The Roth IRA provides lots of flexibilities because you can often take out contributions, not earnings, at any time without taxes or penalties. This flexibility actually makes the Roth IRA a great retirement plan. Okay. The cons: as a traditional IRA, you'll have full control over the investments made in the Roth IRA. And sometimes you'll need to decide how to invest the money. So this is, again, where you talk to your financial planner and determine where is the best way to invest your money within your Roth IRA. What this means to you: a Roth IRA is an excellent choice for its huge tax advantages, and it's an excellent choice if you're able to grow your earnings for retirement and keep the tax man from touching it again. Now, a spousal IRA, many don't know, but let's say that you don't have a retirement through your employer and you're married and your wife doesn't have, or wife or husband doesn't have a retirement plan either. You can set up a spousal IRA, and it basically, the limit income all basically is a combined income with joint income. And so it allows you to contribute based on this same requirements as a traditional or income. I'm sorry, contribution limits for your spousal, but it allows you to go ahead and contribute to your personal one, your individual one, and also contribute to a spousal IRA. Okay. The pros: the biggest positive of the spousal IRA allows a non-working spouse to take advantage of IRA's various benefits, either as a traditional or a Roth version. The cons are there's not a particular downside to spousal IRAs, though, like all IRAs, you'll have to decide how to invest the money. And what it means to you: the spousal IRA allows you to take care of your spouse's retirement planning without forcing your partner to have earned income. Okay. As would usually be the case, this one allows you to go ahead and save for that non-working spouse. Rollover IRAs. Well, a lot of times people will leave a job, right? They'll leave a job and they have a 401k and they want to go ahead and roll their 401k or an IRA to a new IRA account. Now, you can do this, and a lot of times financial planners or you might have come up with a situation where you don't want to get the tax penalties. You can roll your part of your 401k over to an IRA and get some benefits or more flexibility through your IRA. So there are, some tax advantages. You do. Let's go ahead and look at the pros and cons on the next page. The pros: a rollover IRA allows you to continue and take advantage of attractive tax benefits. If you decide to leave an employer or for whatever reason and you want to change IRA providers, you have basically 60 days where you can go ahead and do this. So you can, and they basically do it a number of different ways. You can actually roll it over directly. Sometimes they'll do that for you automatically. Sometimes you actually have to withdraw the money and then go ahead and put it back into a new IRA. But anyway, you've got 60 days to get it done. A SEP IRA. Now, the SEP IRA is one of my favorites for the self-employed. Okay, the SEP IRA is set up like a traditional IRA, but it's for small business owners and their employees. Only the employer can contribute to this plan, and contributions go into a SEP IRA for each employer rather than a trust fund. Self-employed individuals can also set up a SEP IRA. Contribution limits in 2024 are 25% of compensation or $69,000, whichever is less. So it allows you to contribute up to $69,000 to your retirement. Figuring out contribution limits for self-employed individuals is a little bit more complicated. So it's very similar to a profit sharing plan. So anyway, this is a great IRA for self-employed individuals. Let's talk about the pros and cons. For employees, this is a freebie retirement account. Basically, employees don't contribute to a SEP IRA. The employer contributes. There's cons. There's no certainty about how much employees will accumulate in this plan. So it doesn't have to be consistent. Also, the money is more easily accessible, which is nice. This can be viewed as more good than bad, but some people don't view it as being good. So what does it mean to you? Account holders are still tasked with making investment decisions. So yes, they're all tied to investment accounts or tied to investments. Okay, so to break it down, resist the temptation to break open the account early. If you go ahead and tap into it before 59 and a half, you will get that additional 10% penalty. So anyway, I like that one because if you make a lot of profit and you're an S corp, it allows you to deduct that on the business side, reducing your tax liability. Okay, because it's all employer expense. There's also a simple IRA. With 401k plans, employers have to pass several non-discrimination tests each year to make sure that the highly compensated workers aren't contributing too much to the plan relative to the rank and file. Okay. The simple IRA basically bypasses those requirements because the same benefits are provided to all employees. Okay. The employer has a choice of whether he wants to contribute 3% match or make a 2% non-elective contribution, even if the employee saves nothing in her own simple IRA. Pros and cons. Little says most simple IRAs are designed to provide a match. So they provide an opportunity to work for workers to make pre-tax salary deferrals, much like a 401k plan, and receive a matching contribution. Cons, the employee contribution has a limit of $16,000 compared to the $23,000 that's in your 401k or defined contribution plans. What does this mean to you? As with other DC plans or employees have the same decisions to make about how they're going to contribute, how much they need to contribute, and how they want to invest their money. Some entrepreneurs prefer the simple IRA to the SEP, and here are a few key differences of those. You have the solo 401k plan, alternately known as the Solo K, Uni-K, One Participant K, the Solo K. Designed for business owners, for him or her and their spouse. Because the business owner is both the employer and the employee, elected deferrals of up to $23,000 can be made in 2024, plus a non-elective contribution up to 25% of compensation of the total annual contribution of $69,000 for business, not including catch-up contributions of $7,500 additional for those over 50. Pros, if you don't have other employees, a solo is better than a simple because you can contribute more to it. The SEP is a little easier to set up and to terminate. However, if you want to set up a plan as a Roth, you can't do it with a SEP. Okay, so if you want to go ahead and pay taxes in advance, you can't do that with a SEP, but you can with a solo 401k or a solo K. Cons, it's a little more complicated to set up. And once your assets exceed your $250,000, you'll have to file an annual report form 5500 SE for your self-employed. And what it means to you, if you have plans to expand and hire employees, this plan won't work. Okay, you can't use this plan for employees. So once you hire other workers, the IRS mandates that they must be included in the plan if they meet eligibility requirements, and the plan will be subject to non-discrimination testing. The solo 401k compares favorably to the popular SEP IRA too. And traditional pensions. And, there's not a whole lot of those anymore. Basically, the traditional pension, it used to be you work for 30 years at a company and you got your traditional pension. And that's just not the case anymore. Just 14% of Fortune 500 companies entice workers with pension plans. Some teachers still have pensions. Some firefighters, they might have pensions. But these are basically employer funded A common formula is 1.5% final average compensation multiplied by the year's services according to Little. A worker with an average pay of 50,000 over 25-year career, for example, would receive an annual pension of $18,750 or $1,562.50 a month. Nice. And the pros and cons: the benefit, address the longevity risks or the risk of running out of money before you die. If you understand that your company is providing a replacement of 30% to 40% of your pay for the rest of your life, you're getting 40% from your Social Security. This provides a strong baseline for financial security. Additional savings can help, but are not essential to your retirement security. Cons: since the formula is generally tied to years of service and compensation, the benefit grows more rapidly at the end of your career. So if you were to change jobs or you happen to be older, closer to retirement age, when you go to work for a company that provides a pension, you will not be able to save as much. Okay, so what it means to you: since company pensions are increasingly rare and valuable, if you are fortunate enough to have one, leaving the company can be a major decision. So you want to make that decision wisely. Should you stay? Should you go? It depends on the financial strength of your employer, how long you've been with the company, and how close you are to retiring. You can also factor in your job satisfaction and whether better opportunities can be met elsewhere. Okay. And we've got guaranteed income annuities. Guaranteed income annuities are generally not offered by employers, but individuals can buy these annuities and create their own pensions. You could trade a big lump sum at retirement to buy an immediate annuity to get a monthly payment for life, but most people aren't comfortable with the type of arrangement. More popular are the deferred income annuities that are paid over time. So here's an example of a guaranteed income annuity. For example, at age 50, you can begin making premium payments until age 65. If that's when you want to plan to retire, each time you make a payment, it bumps up your payment for life. You could buy these on an after-tax basis or a Roth basis, or in which you'll owe tax only on the plan's earnings, or you can buy it within an IRA and get an upfront tax deduction, but the entire annuity would be taxable when you take the withdrawals. Pros and cons: Little himself invested in deferred income annuity to create income stream for life. It's very satisfying. It felt really good to be building a bigger pension over time. The cons are, if you're not sure you're going to retire, and if you're going to retire, then it may or may not make sense. You're also locking into a strategy that you can't get rid of. In addition, annuities are complex legal contracts, and it can be difficult to understand your rights and rewards for signing up for the annuity. What it means, what it boils down, you'll be getting a bond-like return, and you lose the possibility of getting higher returns in the stock market in exchange for the guaranteed income. But it's probably, a little safer. And there's a federal thrift savings plan. The thrift savings plan is a lot like a 401k, and it's available to government workers and members of the uniformed services. Participants choose from 5 low-cost investment plans, including a bond fund, an S&P 500 index fund, a small cap fund, international stock fund, plus a fund that invests in specialty issued treasury securities. So on top of that, the federal workers can choose among several life cycle funds, which are different target retirement dates that invest those core funds, making investment decisions a little easier. Pros: federal employees can get up a 5% employer contribution to a TSP, which includes 1% non-elective contribution, a dollar-for-dollar match for the next 3%, and a 50% match for the 2% contributes. Wow, that formula is a bit complicated. And so again, if you are interested in this type fund, go ahead and check out the slides, or easier yet, talk to your financial planner. Cons: as a defined contribution plan, there's always uncertainty about what your account balance would be when you retirement. So what it means, you still need to decide how much to contribute, how much to invest, and whether to make a Roth election. However, it makes a lot of sense to contribute at least 5% of your salary to get the maximum employer contribution. Again, take that free money. You really need to take that free money and make sure that you are at least putting in what your employer is going to match. Okay, so we also have cash balance plans. And cash balance plans are a type of a defined benefit or pension plan, but instead of replacing a certain percentage of your income for life, you are promised a certain hypothetical account balance on contribution credits, and investment credits. One common setup for a cash balance plan is the company contribution credit of 6% of pay plus a 5% annual investment credit. Now, the investment credits are a promise. They're not based on an actual contribution. So, for example, let's say a 5% return or an investment credit is promised. If the plan assets earn more, the employer can decrease the contributions. In fact, many companies that want to shed their traditional pension plans convert to a cash balance plan because it allows them more control over the plan. Pros and cons: still provides a promised benefit, and you don't have to contribute anything to it. There's a fair amount of certainty in how much you're going to get. Fair amount. Okay. Cons: in the company changes from a generous pension plan to a cash balance plan, older workers can potentially lose out. Through some companies will grandfather long-term employees into the original plan, and also investment credits are relatively modest, typically 4 to 5%. It becomes with a conservative part of your portfolio. What it means to you: the date you retire will impact your benefit, and working longer is more advantageous. Restricting early can truncate your benefits. It says little. Also, you'll choose from a lump sum or an annuity form benefit. When given the options between a $200,000 lump sum for an annual check or $1,000 for life. So too many people choose the lump sum, and when they'd be better off taking the $1,000 a month for life. It all depends on how long you plan on living and how long. So it may benefit you to take the $1,000 a month for life. Cash value life insurance plans. Some companies offer cash value life insurance plan as a benefit. There are various types: whole life, variable life, universal life. I recommend you talk to an insurance person to discuss the different cash value life plans. But these are similarly, I'm going to go ahead and turn the page to the next point. They are basically similarities to a Roth tax treatment, but they can be more complicated. So that's really why you need an insurance guy that really knows what they're doing. And I work with a number of financial planners, insurance people, and the overall objective is to do financial planning, tax planning, and life expectancy planning and insurance planning. And it's really important that, especially if you are building wealth, that you take these all into consideration as you are building your wealth, and at the same time reducing your tax liability. And here we are, the pros and cons. If addresses multiple risks by providing either a death benefit or a source of income. Okay, cons: if you don't do it right and the policy lapses, you could end up with a big tax bill. So again, that's why you really need to talk with your insurance person, or if you happen to work with us here at Altera Business Solutions, we work with a number of financial planners and insurance people that definitely highly recommend someone that we work well with. And here we are at the last one, and it's been a long one, and I thank you for hanging in there with me, because like I said, it was all things retirement plans, and there's just a lot of information. The last one is the non-qualified deferred compensation plan. And unless you're a top executive in a C-suite, you can pretty much forget about being offered a NQDC plan. There are two types of plan. One looks like a 401k plan with salary deferred. and a company match, and the others are solely funded by the employer. The catch is that most often the latter one is not really funded. The employer puts a writing, a mere promise to pay, and may make bookkeeping entries and set aside funds, but those funds aren't. But those funds are subject to claims by creditors. You may not actually get them. Okay, so that's a lot of information, and so here's the pros and cons. The benefit is you save money on tax deferred basis, but the employer can't take a tax deduction for its contribution in the income tax withdrawals, and until you start paying income tax on the withdrawals. Sorry, I had to re-speak. Okay, the cons. They don't offer as much security because the future promise to pay relies on the solvency of the company. And I've seen this happen a number of times, even with pensions and employers borrowing pensions and not actually being able to pay them out. So, yeah, keep in mind, like when you choose your employer and if they offer a pension, how strong is this employer, or these different types of retirement plans? Are they going to be in business another 30, 40 years so you can actually start receiving your pension? So those are a lot of things to keep in mind when you are looking for a job or looking to change jobs, and the type of retirement plans that are offered to you. All right, so here we get down to the bottom line. But finally, retirement planning is a process everyone should go through as soon as possible to make sure they're on track to meet their goals. You don't want to be one of those 56% of the Americans that don't have any retirement plan, or they believe that they're not going to be ready for retirement. Or one of those 3% of the Americans that actually don't even know how much they need to save for a retirement plan. Actually, I think it's higher than that. Anyway, there's a lot of information, but the bottom line is make sure you do it as soon as possible. Work backwards from where you want to be and how long you want to live during retirement to determine what you need to be saving today. And be sure to make the most of the tax advantage retirement accounts and then choose investments that reflect your risk profile and ultimate plan. I hope we covered it all, and I believe we did. And if you have any more questions, and because of so much information, please be sure to like and subscribe to our channel, either on Facebook, Instagram, or YouTube. And these replays will be available to you. Check back for future live streams. Most of them are not this long. There's just a lot of information when it comes to retirement plans, and we want to make sure that you have it all. So anyway, we thank you for hanging out with us for the hour, and we will see you again next Monday at 11. And we'll see you again next Monday at 11. Thank you.